Now, we're here talking about investment markets and the role of the Investment Committee at FMD. And perhaps it's worthwhile just giving you just a thumbnail sketch of what the Investment Committee is and what we do. The Investment Committee meets every 6 weeks. It's made up of a number of senior advisors at FMD and some outside specialists and consultants. And the role of the committee is to assess what's happening in the investment markets, looking at asset allocation, risk. Risk is very high on our agenda to try and reduce it where possible, and looking at returns that are needed for the long-term security of our clients.
In terms of the historical context of how we've got to have the 6th lowest interest rate in the world, despite having 29 years of uninterrupted economic growth, a world record, it's truly astounding. We were worried during the GFC that cash was going to stop coming out of ATM machines in Dublin. And I saw, a lot of events in London like Brexit, the Euro debt crisis, the taper tantrum from the US. But nonetheless, if you told me when I came back to Australia that after these 29 years of uninterrupted economic growth, we have a current account surplus, we have a fiscal surplus, we have unemployment quite low, around the 5 handle, 5.2%. We have inflation, which is all right, 1.7%, not far from the RBA's target of between 2 and 3, yet we have the same interest rate as the UK. I would have told you that something's gone very wrong in the Australian economy. And this is something that I mentioned to the AFR this week. And something has gone wrong, and there's been an underinvestment in the supply side of Australia's economy for over a decade now. So what that means is that on an international and in a global environment, we're finding it difficult to compete at the moment, and subsequently, one lever that the RBA can pull in order to support our economy is actually reducing interest rates. This is a world that the rest of the developed world have been dealing with now for over a decade, and it looks likely that Australians are late to the party, but we're at the party, and we're going to have to start getting used to rock bottom low interest rates, and that has big implications for your investment portfolios.
The raise in interest rates last year in the September quarter, we saw a significant sell-off in equity markets. So from late August, early September through to Christmas Eve, most world equity markets were down 15%. And that was really on the basis that the markets started to become scared, concerned about interest rates heading towards 3%. And by I mean interest rates 3%, long-term interest rates 3%. And if you can remember another tweet from Donald, he criticised the Reserve Bank or the Federal Reserve there about they were not looking after the US economy because Europe was, maintaining interest rates and trying to keep their currency low to be competitive. And as interest rates rose in the US, their dollar started to strengthen. And on Christmas Eve, he reversed that policy and said, we're done with raising rates. And as a consequence, equity markets became very positive.
Interest rates affect all the assets in our portfolio to different extents. And many of us have got many years of history going back to areas like 1994, when we know what interest rates rising, when they start rising, what they can do, particularly to the fixed interest parts of our portfolio. That's the secure part of our portfolios. We've all got a high exposure to that. We thought we had our portfolios well positioned, so did the market generally. And when it did turn around, we gained some of the outcome from having bonds in the portfolio, government bonds. But like many, we didn't have as much as we wanted to. And when the Reserve Bank, after the election, looked at reducing interest rates further, we certainly had to readjust our portfolios, bring in some more government bond exposures, and to those who invested in our portfolios, we've communicated that to you. So we've had to respond pretty quickly to that through the year.
From an investment committee's point of view, one of the things that really changed during that period when the reversal of the interest rate cycle occurred, in Australia, the Royal Commission has had a marked effect on the lending environment for the general public. So APRA, who's the regulator, put a lot of pressure on banks to be more responsible from a lending point of view. And the outcome of that, we saw house prices in Melbourne and Sydney fall, and I think most parents probably happy to see that a little bit to make kids getting into the market or buying their first house a bit easier. But what that's also done is it's actually created a lack of confidence in the marketplace. And so as construction comes under pressure and projects that have been on the market for a long period of time come to a conclusion, the Reserve Bank is quite aware that maybe next year construction slow down, a rise in unemployment, and they need to be ahead of the curve because it's their only mechanism that they have to actually try and provide some stimulus.
Now, what I'm intrigued about is we've got very low inflation at the moment. Would that be true? Yeah. And yet, I seem to be paying more for things than what I thought I would be with this very low inflation.
So I did an analysis earlier in the year where I looked at the components of official CPI, the Consumer Price Index, since the year 2000, and I basically split up the categories into categories that I define as wants, like discretionary items like buying a new motor vehicle or a new computer, phone, clothing, fancy clothes, furniture, etc., versus needs, things we have to spend money on month in, month out, like insurance or healthcare costs, utilities like gas, water, electricity. For me, school fees are coming up probably down the line in terms of secondary school fees, primary school fees. And I think, again, people are confused because the RBA is saying inflation is low, but when you look at the underlying components and people's actual cost of living, they're finding it hard because these components of inflation are rising at a pace which far surpasses what the RBA is telling you inflation is doing. And it's far surpassing wage growth as well. So people, in actuality, are finding that their standards of living are deteriorating because the stuff that they have to spend money on week in, week out is actually rising very quickly. So it's putting Australian household balance sheets under stress.
Well, I think from an investment point of view, that does create some challenges because the risk-free rate of return, which we used to be able to generate an adequate, acceptable return on your money, no longer can do that. And so what it's done is it's forced all investors collectively around the world, not just here in Australia, it's forced people to take more risk with their investment portfolios. Now, our job as an investment committee is to avoid getting sucked into that trap. Most humans, me included, would like 100% exposure to the share market when it's going up and none when it's going down. That's the reality of life. But when you're trying to build an asset allocation because no one's 100% sure about what is going to happen around the corner, you have to have exposure to all assets. You have to avoid taking too much risk with clients' portfolios, and it's a movement at the margins to try and do that. And we see lots of different fund managers, we see lots of different opportunities, which the investment committee filters. But every fund manager or every institution has slightly different views on the world, and we are trying to navigate the best way to try and give an acceptable rate of return for clients' money, but without compromising risk.
Oh, look, there's no doubt that we've seen this year with interest rates falling where they have to, the share market has rallied. The news said things weren't that good. Well, the numbers, the outright absolute returns in share markets have gone really high in a low interest rate environment.
When we blend Australian equity portfolios together, and Fidelity is a main core part of our Australian equities model, but Zenith, our research partner, allows us to look through the combined position of all our Australian equity managers and tells us how much exposure we have to the banks. So we've deliberately, as a group, had a lower exposure to the banking sector. There potentially will be an opportunity where markets behave irrationally, overdo the sell side, and potentially the banks at some point will become maybe an area that we want to have a bit more exposure to.
Now, what Richard and Mike have been talking about is something that economists call the portfolio rebalancing effect. And again, it's another way to encourage consumption and higher inflation eventually. And what this effect does is it forces people as the gents have been saying, to move out the risk curve in the hope of generating the returns that they once enjoyed from defensive assets. So when your mortgage was 16, 17%, your cash rate was around 12 or 13%. So actually you're probably, in terms of the mortgage today, you can get around 3, you can get nothing on 0. So the differential is not far off. However, what you'll see is that when we think about investing and think about building a balanced portfolio, sometimes it's not good enough to be in cash, because if I have $100 today and inflation is, say, 5%, and I take the $100 out of my bank account in a year's time, I can only buy $95 worth of goods and services, or a basket of consumer items. So I'm actually worse off because inflation's been 5% and I've had 0 interest rate return. So what this chart shows is that you have to go into quite a risky asset class in terms of what we call high yield. It has another name, which is junk, so-called junk bonds. Basically, you lend to companies that are higher credit risk. There's a higher default probability. There's a higher chance when you lend money to these companies that you won't get your money back. By taking that higher risk, you get compensated with a higher return. It's the same by investing in developed market equities. It's the same in emerging market equities. So in coming back to Australia, one thing that I've been talking to our clients like FMD about is this technical effect, which I think will support Australian equity prices, and it has done over the course of this year in conjunction with lower interest rates. I think it's fantastic for Australia's very unique franked dividend system and imputation system. I think those types of companies that issue fully franked dividends or partially franked dividends will see support from Australian investors. And I think one area where Australians are structurally underinvested, which I've been talking to Mike about in particular, and Richard, is emerging market equities, because of the fantastic growth that some of these companies can tap into and the higher returns on offer. But it does come with higher risks.
For those people that have typed in searching Australia recession, 2019 has been the highest year where that search has been put into Google. And I think that's the real reason why the cut in interest rates has had minimal effect thus far. People, when they lose confidence or you see a slowing economy, you see a fear of maybe potentially a job being made redundant, and so people have started to use the lower interest rate environments
Build up their savings.
to build up the savings and pay down their mortgages. It takes a period of time for that confidence to return back to the market, and that's really what we're seeing is a lack of confidence of people ready to put their hand in their wallet and spend.
The further you go out in terms of your investment time horizon over a long time period since 1979 in terms of total returns, so capital appreciation and income dividend growth, you can see that if you had invested for a minimum of 3 years, there was a 91% probability that you were ahead after 3 years. So only unlucky 9% of people suffered a loss investing in the Aussie equity market for over a 3-year time horizon. When that time horizon moves out to 10 years, on no occasion since 1979 has an investor in the Aussie stock market been worse off than when they entered the stock market. So in terms of looking at currencies or looking at equity markets, it's important to filter out that daily noise and increasingly try and assess what is the fundamental workings of the economy.
In the long term.
Exactly.